Since election day to break a months-long fiscal standoff. And SoftBank considers going private by gradually buying back shares. The plan would make further asset sales likely. Matt.
All right, so there's a lot up in the air today. Nonetheless, futures have been higher all morning. You've got Eurostoxx 50 futures up 0.4%, as are FTSE futures and DAX futures. This on optimism that's carried through from that Mnuchin, $916 billion Mnuchin proposal, even though you've still got, of course, the unanswered question of Brexit negotiations as well as the EU budget. And really, U.S. stimulus isn't an answered question either. It's just a proposal from one side. Here we can see live equity indexes opening up in the left-hand column of the global macro movers screen. The FTSE is the first out of the gate as usual. It's up 0.2%. The IBEX now coming in out of Madrid up 0.3%, 0.4%, and the FTSE continues to rise. We see now the CAC 40 up more than 0.5% in Paris. So European markets are opening higher this morning as UK Prime Minister Boris Johnson prepares to, I don't know, did he take the Eurostar or fly to Brussels? Does he drive himself in a sweet little Aston Martin? In any case, he's going to dinner with Ursula von der Leyen to try and break the deadlock over a post-Brexit trade deal. Joining us to talk a little more about this and other issues that we're facing is Justine Colley, Sanlam UK Portfolio Manager. Justine, this is, I guess, for a lot of UK investors, certainly for UK businesses and consumers, the front and center major issue. Do you expect any solution to it in the next 24 hours?
I wish we could say for certainty what a solution will be. There's obviously, as we all know, a 50% chance of a deal or no deal. For us, the important part is if there is a deal, we'll see the pound rally. We'll see domestic stocks, especially in the FTSE 250, perform well. Cyclical and value will perform well. If there isn't a deal, the market will react and there'll be volatility in the short term. That's all we're expecting, but the important thing is positioning around the next, within the next month.
Justine, good morning to you. In terms of the mid caps versus large caps versus small caps story, how do you position yourself in the UK with all of the uncertainty about which stocks are going to be impacted by whatever deal is struck?
It's a pertinent question that clients ask us all the time, and for us, we like to maintain that we are long-term investors. We invest in companies that are resilient, that have high cash flows, that are well capitalized. For us, it's not, we are unconstrained, so we don't look at whether a company is a small, mid-cap or large cap. We look at how our portfolios are diversified with enough exposure around them in order to ensure that if there is volatility, we can participate on the upside, and if there is a drag on performance, that we aren't exposed to the extent that maybe some of our counterparts will be. In terms of what we are seeing now with Brexit, we have exposure to cyclical industries, like, for example, the house builders, say, Howden Joinery. We have some of the real estate like Granger as well that are performing very well, and Rightmove. And we have global players that if it doesn't turn out to be a result that is favorable for the UK, our portfolios will still do well.
So house builders you like, hotel operators you like. These are really, I guess, domestic businesses, or in the latter case, one that counts on tourism. Is the vaccine the reason that you're optimistic on something like a hotel operator?
Well, so we're not looking at the hotel space in general. As you know, and I've mentioned before, we stock pickers. So the hotel space that we are primarily involved in is intercontinental hotels. Now, that as a company is not as reliant on tourism as you would say a company like Airbnb, which is about to IPO, is. It's more resulted around business travel. So yes, a vaccine will help significantly in boost the revenues for that company, which is structured around franchising essentially. But what we have seen, especially in the last couple of weeks with the rally in value plays with cyclical goods, the company has already performed exceptionally well. And we think there's a big opportunity once vaccinations and lockdowns, aren't going on, that the company will have a strong trajectory ahead of it.
Justine, when we look at the Brexit impact on markets, do you own companies that will benefit from a strong pound and also companies that will benefit from a weak pound? Are you positioning around the pound in that sense?
So we don't currency manage our portfolio or currency hedge. We are a global firm, so we have about 2/3 of our portfolio that are predominantly global players. Within the UK, with our UK equity holdings, predominantly most of our holdings are actually global players anyway. We have a very small component of our portfolio that is domestic. We aren't positioning around certain volatility in the UK. We're far more concerned about the viability in the long term of the companies that we hold, regardless of where they are listed.
What about the impact of Brexit on Europe? When you look across those investments in your portfolio, are you concerned about a hard Brexit for the European companies you invest in?
Yeah, so I think if you are a passive investor and you invested broadly across the euro, there is a lot of volatility to be expected, especially around the European Recovery Fund and what the result of that will be. Our investments in Europe are predominantly around alternative investments like infrastructure companies, as well as pharmaceuticals that are well capitalized, like Roche, for example, or Novartis. So for us, an implication of a deal or no deal on those companies, we think will be minimal.
I'm just looking at the share price. I know that Howden Joinery is one of the stocks that you talk about sometimes, Justine, and I think you mentioned it just a little earlier. That stock up by more than 9% this morning. It's given a renewed guidance to the market. It's not an enormous company, but does this tap into a broader theme that you're interested in? I know you're stock pickers, so is it about a broader theme around people spending money on their homes during a pandemic, or is this about the specific management of the company? What's your thinking?
Well, the market, as we know, is really driven by sentiment at the moment. And we've seen, especially in the last week, a major swing from growth to value kind of companies. So it's not surprising that we've seen the performance in Howden. These companies got heavily hit at the beginning of this year. And although we've seen, say, 9% today, they are still far away from levels that we would presume to be fair value. Whether it's thematic is a different story. Yes, people are at home and are spending time on revamping their kitchens. But for us, the management of the company and the way that the company is structured for the long term, their positioning is why we are key believers in holding a name like Howden.
All right, Justine, we're going to keep you with us. We got more to talk about with Justine Colley-Sandlam, UK portfolio manager, on what is an incredibly important day, I guess, for decisions in the market that could affect your investments. Coming up, one of those is obviously deal or no deal in terms of Brexit, the trade talks, what that means for supply chains, and the delivery of fresh food. We're going to be talking about that in just a few minutes with the chairman of Tesco, John Allen. Another important interview. You want to stay with us for. This is Bloomberg.
Welcome back to the European Market Open. 11 minutes into your European equity session, and this is the move to the upside that we see. And part of this has been driven by a narrative developing in the United States. So let's dwell on that for a moment. Treasury Secretary Steven Mnuchin has pitched a new $916 billion relief proposal to House Speaker Nancy Pelosi. This marks the White House's first move since the election to break the stalemate. Democratic leaders called it progress, but said it shouldn't be used to obstruct ongoing bipartisan negotiations. Justine Colley, Sanlam UK portfolio manager, is still with us. And Justine, I know you pick stocks individually, but that is always in a context, and the context at the moment seems to be, despite waiting for a change of power in the United States, growing expectations of some sort of fiscal support. Do you watch with interest that fiscal narrative? Do you think it will develop into something in the US?
Totally, it's been a big topic of conversation and something that we've been watching, throughout the weeks leading up to a decision being made. The most important consideration for us when it comes to the fiscal stimulus is just to get an agreement passed through. There are various companies, especially in the value sector, that need the certainty in the market in order to perform for the long term. So once it is agreed and what that package looks like will provide a lot of certainty to the market, which is needed.
In terms of U.S. stocks, you like Becton Dickinson. That's an American medical technology company. Why this stock? Is this part of a broader healthcare play, or do you see specific company issues that you like at Becton?
So there are two parts of it, really. We are fans of the healthcare sector in general. We have quite an overweight position to both healthcare and tech. Becton Dickinson as a company, we've been following for quite some time. We are very valuation driven. The components of the company, it's the market leader in basically number 1 or 2 market leader in any of the areas that it operates in. It's an exceptionally well-run, managed company, and it's been compounding for the last few decades at least 10% annually, which is a fantastic component to a portfolio.
And in terms of the pharmaceutical sector, Justine, I know that you like some of the bigger names here in Europe as well. Tell us why it makes sense to hold them at this point.
Well, the pharmaceutical sector in general is a necessity, and depending on what these companies are doing, we like to have diversification in our holdings in these sectors. Now, it's not that they listed in Europe as the reason why we're holding them, but for a company, for example, like Novartis, it's typically underappreciated by the market. It's seen as quite a boring conglomerate, really. But if you look at the restructuring and what the holdings it's got in terms of 15 top drugs, the trajectory for new plans, what they do with gene therapy, it's a very exciting component of a portfolio for us.
One of our European stock roundup columns again used the term everything rally, and it does make me think we're seeing that when I look at the IPOs, DoorDash and Airbnb, investors just clamoring to get these shares. Is there just so much cash out there that, even if you have no prospects and throw a SPAC out into the market, it'll get bought up?
I hope that's not the case with retail investors injecting money into the market, but it is a concern when you think that there are all these IPOs, especially in these very growth areas, and they're all being taken up. But the companies that are IPOing, generally, we seem to be probably around the healthcare and tech stocks, and they're doing phenomenally well. The markets the way they are at the moment, with stock prices where they are, with the cost of equity low, it makes a lot of sense for companies to consider listing at the moment. So we are of the opinion that we'll continue to see more IPOs going down the line. People are going to pay for growth, and they're wanting to pay for growth, and that's what we see and they're doing. All
right, Justine, pleasure having you on again. Great to get a look at your portfolio as well. I hope we can get you back. Justine Colley is a Sandler UK portfolio manager. She's going to be continuing the conversation with Anna and myself on Bloomberg Radio, so you can hear more from Justine about her investments in just about 45 minutes' time on London DAB Digital. Coming up here on Bloomberg Television, John Allen, the chairman of Britain's largest supermarket, Tesco, joins us at a time that's incredibly important for his business. What would a no deal Brexit mean for Tesco? It's one of the key things I think that consumers are looking to see. Do you need to run out and stock up on toilet paper, for example? Is it going to be difficult getting fresh fruit and vegetables? We'll put these questions and more to John on the other side of this break. This is Bloomberg.
Welcome back. You're watching the European Market Open here on Bloomberg Television. Now, time is fast running out for the UK to secure a trade deal with the European Union. The British Prime Minister, Boris Johnson, is heading to Brussels this afternoon for crisis talks in an 11th hour bid to break the impasse. The outcome will have huge implications on supply chains, particularly when it comes to delivery of food. Let us talk now to John Allen, the chairman of Tesco and CBI Vice President. John, really good to speak to you once again. We talked to you a month or so ago, a little time ago, and at the time you expressed a bit of concern around fresh food in January, suggesting that this could be disrupted. You did say that things would normalise quickly, but that we would need to be prepared for some disruption. Is that still your view?
Yes, I think you've summarised that beautifully, and our view hasn't changed. I mean, clearly what Tesco, and I'm sure our competitors have been doing, is getting ready for the worst case, which is a no deal. Trying to ensure that we have stockpiled as much as we can of long life product, either in our warehouses or with our suppliers, and what can we do to kind of minimise the risk of food being caught in what's probably going to be the most difficult place, which is the port of Dover and alongside that. So we've been diverting shipments to other ports, and I think I'd still stand by what I said a month ago. I think we may see some short-term disruption. We may see some shortages of fresh foods, particularly short life fresh foods. I think that'll only be for a limited period, perhaps a month or two, before we get back to normal. But of course, there are going to be other impacts as well. If we leave on a no-deal basis, there will be tariffs, and those tariffs can be quite substantial on some food items. So those almost inevitably are going to lead to higher prices. And I think if we go out on a no-deal basis, that's unavoidable.
What kind of inflation do you expect then, John? If we do, I mean, if there is no deal, we do already know what the WTO rules are. Having looked at those, I'm sure, what's the ballpark figure of inflation you're expecting British consumers to be facing?
I think it's low to mid single digits overall, but of course it depends enormously on what you buy, because some of the tariffs on imported dairy products, French cheeses, for instance, can be as high as 40% plus. So there are very high tariffs on some items, much lower on others. If you eat a lot of UK-produced food, it will have less impact. But our estimate would be somewhere in the low to mid single digits, say 3 to 5%.
You're the biggest, Tesco is the biggest grocery business in Northern Ireland. You've talked about concerns around Dover, John. How concerned are you around food getting from Great Britain to Northern Ireland, given the uncertainty still around how that relationship is going to work and be policed?
Yes, well, look, obviously it has been a concern. This agreement that was arrived at yesterday, we don't fully understand the implications of that, but between the UK and the EU, but that may be helpful. But we are prepared in any instance, if we have to provide statutory declarations on food that's being shipped from Great Britain to Northern Ireland. You know, we will have vets in our distribution depots in order to certify that food and so on. So I think we can manage it. It will add a bit of cost, but you know, that's life. So I don't think there's any reason at all for any consumer to panic or to panic buy at the moment. You know, there's still going to be plenty of food in the UK. There may be just a slightly restricted choice for a period of time.
Sticking with the Northern Ireland perspective, John, the Food and Drink Federation said that 40% of their members who do business with Northern Ireland have decided to either cut back or pause or stop moving food and drink to Northern Ireland. Is that something, I assume you're not doing that, but are you seeing that in the broader conversation about food getting into Northern Ireland?
Yes, I know that some suppliers of ours for whom Northern Ireland is a very small part of their business are worried about this. They may get more relaxed once we get into it. So in some cases, they will now be shipping food through our distribution depots, but we will be keeping our Northern Ireland stores, and we are the largest supermarket chain in Northern Ireland, fully stocked of everything that's available to us in the UK. So there's no reason, I think, to feel that our Northern Ireland stores will suffer disproportionately any worse than the rest of the United Kingdom.
I want to ask about Christmas, John. Happily, that holiday comes before the hard Brexit date, and I wonder if you think there's going to be record demand for food this Christmas. Will people get together and eat a turkey or a ham together? Or are the lockdowns going to limit the ability of families to gather and celebrate?
Well, obviously it will have some impact on that, although the restrictions have been, to a limited extent, lifted over the Christmas period. We think people will still celebrate Christmas, but they may do it in a slightly different way, in smaller groups, in order to comply with government regulations. And to that extent, we would anticipate, for example, more demand for smaller turkeys as opposed to larger turkeys. And as far as we can, we, and I'm sure other supermarkets, are attempting to cater for that.
I know that you recently made a decision, Tesco made a decision to repay the UK business rates relief. That was followed by other retailers, John. Why did you decide to do that, having previously suggested you could accept that relief and pay dividends?
Yeah, I think when we started earlier in the year, we really had no idea how much cost would be generated by COVID, and it was a lot. You know, we had sent 26,000 of our staff home on full pay, for instance, put a lot of protective materials and screens into our stores, etc., etc. But as we got into the autumn, it became clear to us that the bulk of that cost was behind us. We were trading well. Our whole industry is trading well. And we felt that, given we had been in receipt of some benefit from government, there were many, many businesses who were doing much worse than us. And perhaps we had a kind of moral imperative, if we could, to repay that money. And that's what we did and announced last week. So it will dent our profits for this year, but we absolutely believed as a board that it was the right thing to do.
What about online shopping? It's something we've done at my house for the first time this year, and I'm sure a lot of others have as well during this period. Are those changes permanent? John, do you need as many physical stores post-COVID?
Well, I think it depends. I think the changes to a lot of people have sampled grocery home shopping for the first time, and some of that will stick. Until we get out of the crisis, it's not really going to be possible to be sure how much. But crudely, we've doubled the number of weekly deliveries we do from about 700,000 a week to about 1.5 million. I doubt if all of that will remain once we get out of the pandemic, but we think there will be a substantial uplift, and we're very much prepared for that. So I think for some people, it will change their shopping habits for a lifetime, and that's something that the industry has to be able to adjust to.
Got it. John, thanks so much for joining us. John Allen there, chairman of Tesco.
Welcome back to the European Market Open, 30 minutes into your trading session. European equity markets moving to the upside. Autos in particular, you can see up by 1.4%. Banks also doing pretty well. Is this the recovery trade back in European equity markets as the Stock 600 makes gains of 0.5% or so? Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. Treasury Secretary Steven Mnuchin is pitching a new $916 billion COVID relief plan. It's the first overture by the Trump administration since Election Day. Democratic leaders say it's progress, but they don't want it to get in the way of ongoing discussions with Republican lawmakers. The U.S. Supreme Court has rejected President Trump's effort to overturn the election results. It offered a one-sentence response to the Republican effort to nullify President-elect Joe Biden's victory in Pennsylvania. President Trump had previously predicted he would be vindicated by the Supreme Court, which has a 6-3 conservative majority. The UK plans to drop the tariffs imposed on $4 billion of US goods as part of the long-running Boeing-Airbus dispute. The government says the move is designed to show the UK is serious about reaching a settlement. Britain will set its own tariff policy when it completes its split from the EU at the end of the year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna, Matt.
Laura, thanks very much. Laura right there in London with your First Word News. Now, SoftBank is considering going private the slow way. Sources say the company may buy back outstanding shares until the founder, Masayoshi Son, has a big enough stake to squeeze out remaining investors. That'd probably take more than a year and will require further asset sales as well. Joining us now to discuss further is Pavel Alpayev, Bloomberg's Asia technology reporter. Pavel, let's start with Son. He's said to be still talking about taking his company private, but it might happen over a year in sort of a slow burn style buyout. Tell us more about what we know.
You know, this idea of a management buyout has been around for at least 5 years that we've been tracking it, but it sort of gained real currency this year. And what's new with the report today is as this so-called slow motion buyout, the key number here would be 66. So in other words, 66% ownership by Masayoshi Son will effectively give him the ability to squeeze out the remaining shareholders without ever having to go out there making an announcement and having to pay a premium, which we expect would be as much as 25%, the old-fashioned way. What also plays in his advantage is that the Japanese disclosure laws are fairly gray zone when it comes to things like that. Short of taking concrete steps like setting up a special committee or getting letters of intent from the lenders for a buyout, Son actually doesn't have to go out and say anything. So that gives him the advantage of being flexible to buy back shares when they're dip and, you know, sit back when the shares are rising. And at the end of the day, if he feels that he has enough to take his company private, he can make that move. Although, of course, judging by the way shares pop today, there are definitely some problems with the strategy.
Yes, so you set out some of the advantages, Pavel. What are the challenges then of taking this approach?
Well, you know, for starters, there are many opponents to the very idea of going private. A lot of people internally believe that staying public will keep Masa's worst impulses in check. It's also a whole lot of money, and having spent all their cash on going private, someone might not have enough cash for another year and a half to do deals, which is really what he wants to do. And people also point out that it's not clear if he can buy back enough shares without driving up the price of the eventual buyout. You know, Son owns about 27%, and after a whole year of buyout share repurchasing, SoftBank only holds 12%. So put together, that's still a long way to go until 66%.
I mean, this has been tried before, recently, in fact, back in March, Masa tried an MBO. How come things are different now, or how are they different?
You're right. This March might have been the closest he ever come to pulling this off. At that time, the market cap of SoftBank about just a third of the total value of its shareholders. He had Elliott Management, Mubadala investments on his side. The problem is he could not convince the banks to foot the remainder of the bill. Now, what's changed since then is that SoftBank is now arguably a much more attractive lending target, in part because he announced a $43 billion asset sell-off, paid down a whole lot of debt, already bought back more than 1 trillion yen, So all in all, someone says as recently as November, he said he's sitting on about $80 billion in cash, and that dramatically changes the picture. And with that much ammunition at his disposal, there's a good reason why investors should be taking these MBO discussions seriously.
All right, Pavel, thanks so much for joining us. Pavel Alpayev there, Bloomberg's Asia technology reporter, talking to us about one of our most read stories of the day, and that is the possibility that SoftBank will attempt a slow burn MBO, basically, or take itself private in a slow motion way. Now, here in Berlin, Angela Merkel is talking at the Bundestag, right behind me there, and a couple of things she's saying are fairly interesting. This is live, by the way, before she heads to Brussels for the summit tomorrow. She is saying that there is still a chance of a Brexit deal, so that's not ruled out in her mind, or at least what she's willing to say publicly. However, she says a level playing field must be ensured in case of Brexit. The integrity of the common market has to remain intact. And then she's also talking about an agreement on the rule of law. This is maybe even a bigger problem for Merkel. She's got to agree with Poland and Hungary about these rule of law clauses in the EU budget. It's a more than $2 trillion budget that's at stake right now, and right now really in jeopardy because of the possibilities of vetoes from Poland and Hungary. Coming up, the stakes are high in terms of Brexit, though. Boris Johnson prepares himself for a difficult dinner date with the European Commissioner, President Ursula von der Leyen, Merkel's former Secretary of Defense. We are live in Brussels next. This is Bloomberg.
Welcome back to the European Market Open. 39 minutes into your trading session here in Europe, and European equity markets looking actually increasingly positive. It's actually thought about fiscal stimulus coming from the United States that seems to be lifting sentiment globally through the past 24 hours or so. Back to the UK, back to the European focus, and specifically the UK around Brexit. The British Prime Minister Boris Johnson will hold crisis talks over dinner this evening when he meets the European Commission President Ursula von der Leyen in Brussels. The pair will work to salvage a post-Brexit trade deal, of course. Bloomberg's Maria Tadeo joins us now from the Belgian capital. We wonder whether fish will be on the menu. At least they will be talking about it, if not eating it. Maria, what kind of compromises are being discussed here?
Well, Anna, about the menu, I'm not sure about the details yet. I'll make sure to find out and report back. But what we do know is that this is going to be a meeting, a three-course meal that the two will talk about over dinner. And the point here is to really try to inject momentum into the talks. And this is what the Europeans are briefing very much this morning. They say this dinner is not a make-or-break moment. If it doesn't go well, it doesn't mean we're headed towards a no deal. But they do say that the briefing coming out of this dinner from von der Leyen to the European leaders will be key. If she's able to tell them tomorrow, the EU 27, Merkel, Macron, when they come here in person, that he is serious about a deal, that the Prime Minister is willing to compromise on some of the sticking points, then that could give momentum to a deal. That could unleash the choreography towards a deal. So it is a dinner that is not just make or break moment for the talks, but it is a dinner that it is key and will be key, especially coming into tomorrow in that summit from European leaders.
All right, Maria, thanks very much. Maria Tadeo there in Brussels following this for us as closely as she possibly can without an invite to the actual dinner. Joining us now is Jagjeet Chadha, Director of the National Institute of Economic and Social Research. Jagjeet, I guess we always knew this would come down to the wire. The question is, how much of a difference is it going to make at this point? I mean, what is the delta between the possibility of a deal here or the kind of deal that would actually go through and a no deal?
Yeah, thank you, Matt. This is a drama that is intensely newsworthy. We're all delighted from the news yesterday that the vaccine is being rolled out. And it's a drama about Brexit that's been going on for 4 years. Our own analysis of whether we end up in a free trade area, agreement of a sort, or a no-deal Brexit, which is kind of loose language for referring to or going back to WTO rules, suggests a small difference between the two, providing it's orderly, providing we don't have the breakdown of trade completely. That's the thing that must be avoided at all costs. And I'm pleased to see the Prime Minister and the President of the European Union meeting and leading to cordial relations subsequently. That's the most important thing of all. Whatever agreement we end up with will evolve over time. Yeah, sorry, go on.
Yeah, so it's about avoiding that chaos or the potential for chaos. Professor Chadha, good morning to you. Whether we get a deal or not, what kind of structural change do we need to see to the UK economy, do you think?
Well, it's the same structural change we've been arguing for many years now. We have an enormous productivity gap compared to where we expected the economy to be. There's a shortage of human and physical capital in many areas that leads the economy vulnerable to shocks. We've seen that as a result of the uncertainty after the Brexit referendum and the actual shock that many households and firms are facing in light of COVID. So it needs a consistent and sustained effort by the government to promote investment across the country. There is a levelling up agenda, but the amounts being talked about are short-term and small compared to what's required. And these will also, at the same time, help us confront the very real risks to trade from Brexit, which is actually going to hit the parts of the economy that have been basically insulated from the COVID shock. It will particularly hit manufacturing, IT, finance. And in fact, last week at the Treasury Committee, I described it as the Heineken shock. It's going to hit parts of the economy that COVID didn't particularly hit. And that's a problem. It's a problem the government must confront very early and in a sustained manner, following whatever happens in the next few days, which is a drama we're all interested in, but in the end doesn't materially matter for the country's prospects and those of households.
Hang on, did you say Heineken shock, as in the Dutch brewer? Can you explain?
Well, am I allowed to say that? It used to be a very popular advert in the UK. Heineken reaches the parts that other beers cannot reach, whether I can say that first thing in the morning. But the idea essentially is that COVID is a short-run shock, particularly affecting those bits of industry that require social interactions of an important level. But Brexit is a shock on the long run of the economy that impacts on the trade and those areas that have been insulated to the extent to which high-value services have been able to operate during the COVID crisis, but will be affected by this kind of exit, particularly if we don't have a clear agreement on services, which is, nobody can spell out exactly how services will be treated, financial or otherwise, from 2021 onwards.
Well, I have to say that's a Heineken ad with which I am not familiar. One British ad that I love is the age-old Tesco, every little helps. And we just spoke with the chairman, John Allen, who said he expects, he definitely expects some inflation headed towards UK consumers after this. I wonder if you see inflation either way. I mean, deal or no deal, don't prices rise for UK consumers?
Well, we're a very open economy, and therefore if large amounts of the goods and services that we import, either directly for consumption or as part of the global value chain, go up in price, either through tariffs or a depreciation in exchange rate, which would be the financial markets perhaps suggesting a loss of some confidence in the prospects for the UK economy, that will lead to a one-off increase in the price level and a temporary inflation. I don't think there's any great evidence to suggest there will be a sustained inflation. There is a risk, of course, if the Bank of England were to lose control of price stability, but that seems very unlikely. We have a lot of leeway on the upside to raise interest rates if we need to control inflation. And providing we have that traction on the economy, there's no particular concern for inflation in the medium term. Inflation expectations look well anchored. I know that sounds like a sort of standard canard in this area, but there is no evidence of any great upward drift in inflation expectations. So I think we can be sure that, or reasonably sure, that inflation is not the primary risk the UK economy is facing at the moment. It's more that we don't recover in the way we might have otherwise have done because of Brexit and because of lack of government planning to deal with the impact of Brexit and the recovery from COVID. That's a bigger risk, it seems to me, one of government failure rather than central banks.
We were looking at two-year inflation swaps suggesting some increasing pricing in of inflation, but maybe, Professor, maybe that doesn't last. Let me just finally take us onto the subject of how we pay for the coronavirus crisis and the money the government has thrown at it. What would you suggest? I was looking at some research by the Wealth Tax Commission that's suggesting a $350 billion or so, translate that into pounds, a wealth tax to pay for the pandemic. What would your suggestion be for how we pay for it? Or maybe crucially, over what time frame?
Yeah, I think that's exactly right, Anna. It's the time frame. We can wait. Interest rates, because of the global savings ratios have risen throughout the world, and the fact the UK, despite what I've just said, still remains a reasonably safe place to park your money, means that we can wait. There is no high level of interest payment on the debt that we've got. Yes, the level of debt has gone into more than 100% of GDP, which is as high as ever been in peacetime. But the interest payments on that are less than 2% of GDP. That means there's no immediate need for the government to think or state tax increases. Now, there may be all kinds of things that are appropriate, but I don't think it's a good idea to target one particular sector without thinking about the whole structure of the economy, post-Brexit, post-COVID. What kind of taxes do we need in a few years' time to help bring the level of debt down? And that is relative to GDP. And it turns out the most important way of dealing with that is to lead to growth in the economy, to think about policies that will address the productivity puzzle, that will address the capital investment and human capital gaps that we have in a sustained manner. And that will, of course, bring down debt to GDP because GDP will rise. And what we need is a framework that says, look, we will be increasing revenues and taxes, but only on the back of a sustained examination of the whole of the economy.
Professor Chadha, thank you so much for joining us. Jagjit Chadha, Director of the National Institute of Economic and Social Research. Thanks very much for your time this morning. Up next on the programme, will the euro strength impact risk assets? We will put that question to Market Live's Christine Aquino. She joins us next. This is Bloomberg.
Welcome back to Bloomberg Markets. This is the European Open. We are 52 minutes into the session right now and looking at gains. The DAX is up more than 1%, the biggest gainer among the major European equity indexes. The FTSE not far behind it, though, gaining about 0.9%. So we're up across the board after new records were reached yesterday in the U.S. session. This has been driven by optimism about a stimulus package from Steve Mnuchin. He suggested $916 billion. And maybe optimism about Boris Johnson's dinner with Ursula von der Leyen. He's a fairly charming man. He may be able to get a deal through. But if not, he says he's okay with that as well. Of course, there are a number of other issues, including the EU budget, that need to be dealt with in Brussels tomorrow. Bluecrest Capital, the investment firm led by billionaire trader Mike Platt, will return $170 million of its money to former investors. The settlement comes as the SEC said Bluecrest prioritized an internal hedge fund over its clients' money. Here are the details of this. Is Bloomberg's Danny Berger. Danny?
Matt, so the SEC here is looking at a very specific time frame from 2011 when Bluecrest opened this internal fund to manage Michael Platt's money to 2015 when it stops managing outside money and just focuses on the internal funds. The allegation here is that for its outside clients, Bluecrest really just gave them the...
Good morning, ladies and gentlemen. I'm going to place a stop on profit for euro. As you can see, yesterday, we purchased euro at 121.11. So I'm going to place a stop on profit to 121.21. Okay. It will give us 1,000 pounds in profit. Okay. So this is where I'm going to place the stop on profit. For all of you guys who not using our strategy, you can get it from our website, and you can follow our trades, practice, and you can make the same profit as we do. Just to remind you that 1 pip with our trades, let me output because it distracts me. 1 pip costs worth 100 pounds. So every time if it goes up, we make 100 pounds. Every time when if we purchase, for example, euro, you say yes. Every time when it goes down, we lose 100 pounds. Okay. When you will purchase strategy, you will see why we and how we can buy the same pairs and sell at the same time, how to hedge positions. All of this you can discover, you can find out from our course and strategy that available on our website. You can see it from the ticker, green one. Okay, that's it. So we're already in healthy profit. So let's see where euro will go. If it will go further up, I will probably put further my stop on profit because I don't want to hold it. Every time for those of you who not familiar with CFD, contract for difference, every time when you hold overnight positions, you have to pay to broker for overnight holdings. But every time when you sell short, broker pays you. So in my case and in our company case, all short positions you can see, for example, we hold on euro against United States dollar. We don't lose any money at all because broker pays us for holding short positions. But every time when we hold long positions, we pay to broker. Okay, speak to you later, guys.
Table for two. Boris Johnson and Ursula von der Leyen meet over dinner tonight. Will it be a palate cleanser they need to reach a Brexit deal? A new stimulus deal could be underway. Treasury Secretary Steve Mnuchin presents a new $916 billion relief proposal. It's the first move by the Trump administration since Election Day to break a months-long standoff. And SoftBank considers going private by gradually buying back shares. The plan would make further asset sales likely. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's check on the markets, and then, of course, the interview of the day is with Remo Ruffini, who just did a massive consolidation in Italy with buying Stone Island. We'll get to that in a second, but first, to check on the markets. Now, the market definitely focused on what's going on with Brexit. The market also climbing on hopes for stimulus in the U.S. So if you look at global stocks, we're seeing new record highs, or at least close to new record highs, as hopes of a U.S. stimulus deal countered concern about a surge in coronavirus cases. And then, of course, on the Brexit front, the pound is rallying as the UK Prime Minister Boris Johnson is traveling to Brussels for a tete-a-tete with the European Commission President to save Brexit trade negotiations. Now, there's a new luxury, or there's a new house of luxury on the block. Moncler has agreed to buy high-end sportswear brand Stone Island in what is its first major acquisition. The €1.15 billion deal marks a new growth strategy for the Italian company after turning down a takeover approach by Kering last year. Well, joining us, I'm delighted, is Remo Ruffini. He's the chairman and chief executive officer of Moncler. Mr. Ruffini, thank you so much for giving Bloomberg a little bit of your precious time. With this operation, and congratulations on the deal, what are you hoping to achieve? Is this a new luxury conglomerate that you will create?
Well, actually, now I'm very concentrated on this deal because for us it's quite a big deal. Having said that, never say never. But last Friday when we decided to close and I prepared the press release, the title was beyond fashion and beyond luxury. We really try always to find something to be as much unique as we can, and who knows? But that's what I have in mind is to build something for a young generation. For me, the young generation is everything. If you think, the guy, they have 25 years old today, in the next 5 years could be 50% of the luxury market. I think it's very important to be concentrated on that. I always care about all my customers, from the people that love to snowboarding, the people that use the jacket to go in the office. But I think now is very important also with Stone Island to concentrate to this younger generation, because in the near future will be the market.
So does it mean that actually the luxury, sportswear will become a little bit more relaxed, like Stone Island? Or are you planning to transform Stone Island into maybe a bit more of a luxury brand? How do you see the two marrying each other?
I think Stone Island is very charming for young kids today. I think we are quite a unique position in the luxury market. I always say something between Nike and Hermes, and this I think is a very strong position. Is not only belong to us. I think LV, since where they are, Vuitton, since where they are, these guys for the men's line, Virgil Abloh, but there was kind of a DJ, or the communication they have today with your home, with Kim Johnson. I think is very keen to talk with the young generation. They just did 3-4 months ago a collaboration with Nike. I really think about, Dior was on top of the super luxury. Also this brand need to talk, with the young kids, and they have collaboration with Nike. Means I think we can take, Stone Island in this, let's say, luxury unique positioning, and this will be my job for the next, let's say, 12 months. I think we have a possibility. It's only men's. It's very clear. It's very pure. I think is quite unique in terms of positioning, quite unique in terms of product, in terms of strategy. I really am quite, I don't say sure because I'm not sure, but I really want to take them into this position in more luxury, more on this world.
So what do you hope to learn from each other between Stone Island and Moncler? Of course, the entry point is very different from Stone Island. You're going for a younger customer. Will you kind of try and blend, or will you keep them completely separate with, some of the pop-ups and some of the collaborations that you were just talking about for Stone Island?
No, I think we want to keep separate. I think we want to really built two strategy, two company. We have a totally different DNA. I want to keep this strong DNA. I always say we don't have to betray our roots. But having said that, we can help them a lot because, in terms of distribution, for example, they are quite strong in Europe, but they are quite young in Asia. We have quite a good knowledge in Asia. We have quite a good knowledge in Japan, in China, in Korea. I think we can help a lot them to develop their own business, especially on the retail side in all these markets. Also in the United States, they are quite young. Let's say they have 2 or 3 stores, 4 stores. I think in terms of, I always trust that today you have to build your strategy based on experience, based on digital, based on physical, and then really try to find with the data to build up a strong omni-channel. And I think they are quite, let's say, young on this kind of strategy, but I think we can help them a lot to develop these ideas.
Remo Ruffini, how do you think luxury is changing? And is it, towards more casual wear anyway? Is it because of the pandemic, or has it just been accelerated by the pandemic?
I think they accelerated. As you know, as the last time we talked, almost 2-3 years ago, I changed everything. I changed the strategy of my company because I felt the world of luxury was changed. Now Moncler is based on not anymore on season, but it's based on monthly business, monthly delivery, monthly project, monthly editorial. Basically we have editorial every day. We have ideas every day to talk with our customer. And this pandemic accelerate everything. In terms of we cannot say anymore we have, as I said before, we cannot make a physical business or digital business. We really have to understand all the platform that in Europe is not very difficult as well in America. But when you start talking with the Chinese market, we have to make special project with chat. I mean, what we call mini program. Then we must be able to talk with Weibo or the luxury platform of Alibaba like Tmall. I mean, the world is very complicated, but actually it's very, very exciting because you really have to be very fast. You really must be able to talk with a different platform, different idea, different way to work. E-tailers is very important in Europe. Again, multi-brand for me is very important to build up your own brand. I feel even digital or physical, there is a lot of energy in the multi-brand. Means you have a lot of opportunity, a lot of platform, but for sure the luxury business totally change, totally change.
Remo, how big do you think your group will become? So if you look at this, and there was many rumors exactly 12 months ago about a French group wanting to buy Moncler. Does this flip it? Again, what's your ambition longer term? I know we talked about it a bit at the beginning of the program, but how big will you be in 3 years from now, in 4 years, in 5 years, and what will you focus on? Is it the Asian markets, and is it e-commerce?
I mean, 1 year ago, I said it true, as like I said today, I always talk with everyone because for me the most important thing is create value for my company, create value for Moncler. And I think that the world is changed. I think in 3 years is this acceleration of the pandemic, I think is honestly is already today. I think tomorrow we really need to be as global as we can, able to work with data. I think data is the key for the digital business for sure, but is also key for a physical business. Means data is one of the most important things. You have to be really strong on digital because I think you have to contact your customer through digital. Then you have to, with the omni-channel, as I said before, you have really to take them to digital, to retailers, to the physical, to our stores. Means is quite a complicated world today, but I think is very, very, very strong and very exciting. If we say that in 3 years, I hope Moncler will be in the game of the luxury world with a new approach, with the young generation, with the new approach with all the different markets.
What is the toughest thing to do right now, Remo? Given we're coming out of the crisis, is Europe your hardest region?
This is for sure, the pandemic was quite tough for our industries. Actually, in March and April, China was recovered very fast, and China is booming now since May, April, May is booming. China is very strong. Korea never locked down, means Korea is quite a good market as well. Actually, Japan is up and down. It depends on what the prime minister say. One day he says, okay. I mean, the number of cases is very small, but the Japanese is very keen to respect what the government said. The biggest problem for sure is Europe. Europe, as you know, for the luxury market, 50% is travelers, 50% is tourist. Means we lost 50% of the business. Plus, we have a very long lockdown in March, in April, almost in May, then in November again. Means it's quite tough. We hope December will be strong, because for us this is our season basically. America was quite surprising. You know, before the election, the market was quite strong. The reaction was very good. Then with the election, they become so-so, and think now it's okay. It's better than 1 month ago. Again, I think winter is starting now. It means for us is really our season. We have December, January, February. Normally is very strong. I hope it would be strong also this year.
Remo, thank you so much for all of your insight. Remo Ruffini there, the Chairman and Chief Executive Officer of Moncler, on the future of luxury and, of course, on this great deal buying Stone Island this week. Now, in the meantime, we're also getting some breaking news out of Brexit. Don't forget Brexit. It's not because we talk about M&A and consolidation and retail and luxury that we don't always have an eye on Brexit. We know that Boris Johnson will travel to Brussels later on and will have a tete-a-tete dinner with the President of the European Commission, Ursula von der Leyen, and we understand that that dinner is due to start at 7 p.m. UK time. That's 8 o'clock on trend. We'll also have to say what the menu is. There's so many jokes on social media that it has to do with fish, but then you don't know whose fish the fish, if it is the Brits on a French vessel. But it all feels very Brexit-y. Coming up, the Brexit showdown is served. We'll have plenty more, of course, on that dinner between Boris Johnson and President von der Leyen. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, we're just getting news, or we had news in the last 3 minutes, that Ursula von der Leyen and Mr. Boris Johnson will have a tete-a-tete dinner. I'm not sure whether they'll be flanked by aides. We don't know the menu, but the timing has been confirmed at 7 p.m. UK time, 8 p.m. Brussels time. So joining us now from Brussels, who will no doubt try to be close to the dinner and try to eavesdrop, is our Maria Tadeo. Maria, it's going to be possibly, a tense dinner conversation coming up this evening.
Yes, Francine, and the timing now confirmed for 8 p.m. The dinner is happening in the Berlaymont building just behind us. That's on the 13th floor. That's Ursula von der Leyen's personal office space. And look, this morning, European officials briefing that they don't really see this as a hard deadline. And it's not really make or break, but it is an important dinner, and it is crucial that von der Leyen leaves that dinner with a good briefing to put to European leaders tomorrow when they come here to Brussels. And that will be the key. Von der Leyen telling Macron, telling Merkel and the rest of the EU 27, I do get the impression that he is serious about a deal. He does want to get a deal. Let's get back on track. So it's more about injecting momentum and making sure that the talks do get restarted by the weekend. That could unleash the choreography towards the deal, but it will very much depend on the outcome of that briefing from von der Leyen after a dinner.
I mean, there's nothing a bit like food diplomacy. I don't know whether we have the dinner or what we know, if we know, Maria, what's on the menu, but usually it sends very clear messages about what they need to negotiate.
Yes, and Francine, look, we don't know if there's fish. We don't know if the Europeans are going to go for soft diplomacy or want to get a pun in the menu, but as soon as I find out, I'll make sure to report back. What we do know, however, is that this will be a 3-course meal.
All right, we'll keep an eye on it. I mean, there's so many jokes out there on what they're going to have for dinner that I can't tell whether it's, truth or lies. So I'll hold back in making any of those jokes, Maria, and we'll check in back with you to see if it is indeed fish, and fish by which vessel. Now, joining us to talk about Brexit on a serious note is Melanie Baker, senior economist at Royal London Asset Management. Melanie, always great to speak to you. Thank you so much for coming on today. When you look at the Brexit negotiations, I mean, I don't think we're expecting a deal, at least by the end of dinner tonight, but it is about injecting momentum, at least going back to the negotiating table. What does that mean for the UK economy? Like, what are your hopes of a deal at this moment?
Well, I'm feeling less confident than I was, even just a few weeks ago. These talks really need a bit of political momentum, and hopefully that's what they'll get at the end of today. But we're really getting very, very late in the day. I would have expected more movement at a higher political level earlier than we're getting. In terms of the UK economy, look, I mean, whether it's deal or no deal, we're going to have substantial disruption, I think, at the border over the new year, which will weigh down on the economy early next year. And of course, you've got that against a backdrop of continued COVID challenges. So it's going to be a tough start to the year, I think, in the UK, really, no matter what the outcome.
Melanie, but are companies ready for it? So substantial disruption, but people know what they'll do come January 1st, or are we just unprepared for a transition?
Oh, this is the problem. So I think, if you look at the Bank of England did an interesting survey in the November monetary policy report, and they found that many businesses are replying that they're as ready as they can be. Right? So, what does that really mean? I mean, for a lot of companies, it's still not at all clear what the trading conditions are actually going to be at the start of the year. Will there be tariffs? Won't there be tariffs? And there are lots of questions still around the readiness of some of the systems needed around cross-border trade. There's a limit to really how far companies can prepare.
What does it mean for Brexit? Sorry, what does it mean for pound? What does Brexit mean for pound? How much weaker can it go, Melanie?
That's a really good question. I mean, you can see, you see the movement in sterling, right, over recent days, well, actually recent years. It's very sensitive to changes in mood music around Brexit, to breaking Brexit news. So, if there's a no deal, I mean, I've penciled in a significant decline, possibly 10%, but that's finger in the air stuff, really. We know it's sensitive and it will react in either direction depending on the outcome of the talks. I think what isn't clear at the moment is exactly when we'll find out that we've got a clear outcome to these talks. It seems evident that any deadline that gets mooted isn't really a deadline at all. And the one that matters, I think, is still the 31st of December.
Thank you so much. Melanie Baker there from Royal London Asset Management stays with us. We'll talk about U.S. stimulus shortly. Coming up, Mnuchin's counteroffer, the U.S. Treasury Secretary proposes a $916 billion stimulus plan that includes state aid. But Democrats call parts of it unacceptable. So we discuss that next. This is Bloomberg. Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Treasury Secretary Steve Mnuchin has pitched a new $960 billion relief proposal to House Speaker Nancy Pelosi. This marks the White House's first move since the election to break the stalemate. Democratic leaders called it progress, but said it shouldn't be used to obstruct ongoing bipartisan negotiations. Well, still with us is Melanie Baker from Royal London Asset Management. Melanie, as we take stock of 2020 and look forward to 2021, how much will a game changer, or will the stimulus be a game changer for the U.S. economy?
Well, it's really important. I mean, we know things aren't. We've got a vaccine, but things aren't going to get back to normal in the near term. We're probably talking the second half of next year before we get widespread vaccine availability, and then you can have a kind of return to a semblance of normality. In between, then economies need support, labour markets need support, businesses still need support. So, yeah, no, it's still very important that we get a fiscal package in the US.
Is there a size that matters more than where the money goes? Or, you know, even if we get a smaller stimulus, markets will be okay as long as it's spent wisely?
I think markets would be okay with a sort of the stimulus of the size being mooted at the moment, and the economy can tick along with a stimulus of that size, absolutely. So, you know, we've got two proposals being talked about, all in the kind of around the kind of 900 billion mark. It's still not clear to me though that all three sides effectively can come together and get an agreement this side of Biden's inauguration.
Melanie, when you look at some of the scarring in the economy, do you worry that the scarring will be deeper than expected, or like Jeffrey Gundlach, do you worry that we see a suddenly spur of inflation above 2%?
I worry about both eventualities, really. I mean, I think on I've become a little less worried as I've looked more closely at the consumer story, I think. So I think generally governments have done, actually, globally done a really good job of protecting household finances, so that, as households become more confident, many of them have got spending power that they can then release. Savings rates jumped in the first part of the crisis. If you look at the levels of deposits held at banks, they remain higher than you'd expect. So there is spending power there once households feel more confident. But sure, I mean, it do worry about labour market scarring still. I worry about corporate debt overhang. Certainly those concerns haven't.
Melanie, thanks so much. Melanie Baker there, the senior economist at Royal London Asset Management. Coming up, it's the ETF Europe show. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lacquen. Over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. Strongest month on record, equity ETFs added more than 16 billion euros of new cash in November, jumping ahead of fixed income for the year. Gold withdrawals pushed commodity ETPs deep into the red. As a peer-reviewed study of the shot developed by AstraZeneca and Oxford University says key questions remain unanswered, we'll bring you the latest on the vaccine news driving ETFs. And changing course as Vanguard closes its suite of smart beta ETFs in Europe. We'll also look at the shifting strategy at the world's second largest asset manager. Now, first thing is first, as always, let's take a look at which countries and sectors have been attracting the money. Our very own Danny Berger has all the details. Hi, Danny.
Hi, Francine. Looking at FFLO Go, so these are ETFs that track European regions. And what's notable here is the unrelenting nature of flows into European ETFs. For the past week, we saw a net inflow of nearly $650 million. The majority of the funds this week, as it was last week, I should point out, coming in from the UK, so over $700 million coming into regions tracking there. I think it's really interesting also to look at the UK and look at the really tactical nature of flows coming in and out of those ETFs. For example, one ETF, its ticker QUID is what it's called, perhaps very appropriately. It's from PIMCO. It's a short sterling ETF. Last week, we saw it have a near record outflow. In one day, we started to see that short sterling flow come back, perhaps as Brexit talks are ongoing. That sort of question really impacting that fund there. So it really just shows you how European ETFs, it's not just this exuberance over this value play coming back in, but it's also purely tactical as well. Germany, net outflows, the biggest loser so far this week, 136 million getting pulled out. We should note Germany seeing record COVID deaths, certainly impacting some of the sentiment there, but still overall, those record inflows we saw in November, as of now, continue to be holding up in terms of European ETFs, Francine.
Danny, thank you so much. Our Danny Berger there with the funds and the flows. Now with us, Deborah Furr, managing partner and founder at ETF GI. Deborah, great to have you on ETF IQ Europe. When you look at the funds and the flows, I mean, what's been supporting this pretty record year?
So I think for many investors, it's been the fact that ETFs allow you to get in very small sizes anytime during the trading day. I think they've suited retail investors, financial advisors, and also institutions. And so you've seen that many investors are using ETFs tactically. Others are using them as core holdings. And I think that the fact that ETFs performed really well during the volatile March and April timeframe caused many investors to turn to them, especially after the Fed decided to start investing in them. So that gave a lot of people more confidence in using the products.
Does it mean, Deborah, that actually the only way forward is up? Is this just a market that will grow and grow in Europe?
I do think that ETFs will continue to grow. I'm seeing investors, in Latin America and Asia, across Europe, using the UCITS ETFs that are domiciled here. And I think that regulatory changes in Brazil, the biggest market in Latin America, where they're going to allow Brazilian depository receipts on foreign ETFs, is a big opening up of that market. We've seen investors in Mexico, Chile, Peru embracing UCITS products, especially as core holdings. They tend to use US-listed ETFs more as tactical sleeves. And I think if you look at changes in Hong Kong and Asia, you're seeing a greater adoption of using UCITS, especially with the feeder funds that have changed regulations where the local regulator in Hong Kong now only regulates the feeder fund and not the primary listing. So I expect to see increasing use of UCITS ETFs around the world.
Deborah, what do people want from ETFs? I mean, is it just because there's so much available that they can diversify, or what's the attractiveness? I know in the US you get tax breaks and things like that, which you don't have in Europe.
Yeah, so I think what people like about ETFs is the fact that you can use them as building blocks. I also think that the firms that are launching ETFs are listening to investors and are very innovative at adopting to ESG. So we've seen when you look at Europe actually is the leader in ESG. We account for 53% of the assets. If you were to look globally at the ETF industry, we're at a record 7.58 trillion. Europe only accounts for 16%, and the US accounts for about 70%. So Europe is really a leader in terms of assets and product development. And we saw today that Legal & General has just launched some ESG fixed income. So fixed income in Europe is both equities and fixed income. In the US, it's still early days for the adoption, and I think also out in Asia, but I expect that trend to continue. I also think that thematic, so investors are using ESG to play themes that they think will benefit from post-pandemic environment. So whether that's technology, whether it's healthcare, they're also investing in countries where they feel they've dealt with COVID better. And clearly the expectation with Biden is that ESG will become a priority there. So we do expect that to grow. And I think that a Biden government will also be more positive and constructive the way it deals with trade and many other issues.
Deborah, where do you see you mentioned some of the key themes that we try and explore every week here on the ETF IQ Europe show, but what is the one theme that you think will just bring much more attention in ETF? How much bigger, for example, does the ESG ETF space have to grow in Europe?
I think it's going to grow very significantly. What we're seeing are many investors are switching out of core beta indices into ESGs. So it's not just little bits of dribs and drabs going in, it's now significant changes in mandates. And I think that will continue to happen. I also think another big change is Chinese bonds. So people are looking for yield. And with FTSE and Bloomberg deciding to put Chinese bonds into their indices in 2021, we're seeing significant increase in interest in those products. CSOP had a launch about a month ago with $645 million at launch. It got to over $1 billion in size within 2 weeks. So I think that emerging markets looking for yield, and you mentioned smart beta. I think one of the things we are seeing is a move away from smart beta, especially as companies have decided to pay out less dividends. Dividends used to account for about a third of smart beta assets and strategies. And so we're seeing investors move, as I said, more to ESG, more to thematics, and more to countries that they think will benefit from post-pandemic environments.
Deborah, thanks so much. Deborah Further from ETF GI stays with us. Coming up, a peer-reviewed study of the shot developed by AstraZeneca and the University of Oxford says some key questions remain unanswered. So we'll bring you the latest with the developments in the vaccine and try and figure out what that means for the economy, what it means for the markets, and therefore what it means for ETFs. This is Bloomberg. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows, and I'm Francine Lacqua. Now let's get the latest on the coronavirus vaccine. A peer-reviewed study of the shot developed by AstraZeneca and the University of Oxford said some key questions remain unanswered. Results published in The Lancet found the vaccine was safe and effective, but more analysis will be needed to see how well it works in older people. Well, let's speak to our Sam Fazeli, Senior Pharmaceuticals Analyst for Bloomberg Intelligence. Sam, always great to speak to you. Where are we on this AstraZeneca vaccine?
Yeah, hi, Francine. So the data are pretty much, from a headline perspective, similar to what they talked about, the 70% or so efficacy when you combine the Brazil data with the UK data, etc. So, you know, it does tick the box for regulatory approval. But there are questions in here with regards to, as you said, does it work well in old people? We don't know. Anyone over the age of 55, very few individuals in the trial in that one. And then, of course, you have all the issues with the low dose, standard dose, and all that going on. So I do think that there's a lot more that needs to be done to be completely sure about this vaccine and how valuable it is in terms of how efficacious it is. But I think the top line should be viewed as this is something that we can use as a tool to manage the pandemic.
Sam, where are we going to be on vaccines come January of 2021? How much of, will we be in a real game-changing place by the first quarter of next year?
Yeah, so I have to, we need to define what game-changing means. I think we should be in a position to have vaccinated the most susceptible individuals in our society, in the UK and in the US, to hopefully reduce the risk of severe COVID and hospitalizations, etc. So that is quite important, and I think we should be feeling that effect in the first quarter.
Sam, when you look at what it means for lockdowns, what it means for how there's so many questions still about the vaccine. Do you think it will be a bumpy ride in terms of trials and what we find out about the vaccine in 2021? Or will it just be encouraging news from now on? I know it's almost impossible to say, but what's your feeling on this?
Yeah, well, I'll go for the little part of that. It's not almost impossible. We've seen now that these vaccines can cause a good efficacy in people. We know that they certainly, across the three vaccines that we've heard about, Pfizer, BioNTech, Moderna, and AstraZeneca, reduce cases of severe COVID and hospitalizations. So that's one common area that we can get excited by, and therefore I expect the other trials to do the same. Maybe Johnson & Johnson's first trial that reads out will be single-dose vaccine. Maybe that won't be as good, but I'm still hoping. And certainly Novavax, I expect a positive outcome from too. What the level of efficacy will it be 70, 80, 90% and all that? I think currently in the bigger context of things doesn't matter.
Thank you so much, Sam Fazeli, there, Senior Pharmaceutical Analyst for Bloomberg Intelligence. Now, still with us, Deborah Furr from ETF-GI. Deborah, when you look at the leaps and bounds that vaccines have made, they will definitely give impetus to the recovery, how fast it recovers, and therefore to asset classes. Is all the good news on vaccine now already priced in markets?
I don't think so. I think that, it's still a little bit early days. I think we've clearly seen the market react to the fact that there are vaccines coming out. But I think as we see more of them come out, we see them being distributed and that people are taking them. I think people will go back to work. People will start shopping more. I think people will start to travel. And so I think we will see a very good 2021 in terms of the economy and how it performs. I think then we'll go back to more normal levels in 2022.
2022, what kind of activity will we see, like more normal, as in
more normal, meaning kind of baseline what you would expect? I think we'll see a definite increase in spending and activity from investors, because many people have been sitting at home not doing much of anything, right? They haven't been going out to eat, they haven't been traveling, they haven't been buying much, you haven't needed new clothes to sit in front of Zoom, right? You can change your tops and have your pajama bottoms on if you want. So I think that people will spend and they will go out and enjoy life again. So I think everyone's looking forward to that. And I do think that that will cause spending. I think also with the change in government in the US, we're going to see some changes there. I think stimulus is expected to be passed, hopefully sooner, but definitely when Biden comes in, I think that they will get around that, and that's going to help the US economy also. So I think the US economy will react positively, I believe, to Biden getting into office and stopping kind of this debate of what's happening right now.
Deborah, yeah, I like it. You call it as it is. We all call it leisure wear, but actually, in most cases, it is just pajama bottoms. So is it only when we have a catch-up? I mean, do we need to be a point in the economy where we have a catch-up of where we would have been had we not had the pandemic, that, that we see a big uptake in thematic ETFs?
I think we're already seeing that uptake. So for many people, they're looking at where should they put money to work where they think there's going to be a benefit. I think many people will still work from home. So I think technology that's going to be used in this environment where people might go back to the office certain days of the week, not everyone's going to be in the office all the time. So I think technology, disruptive technology, electronic cars, thematic also crosses into ESG. I think healthcare is already seeing significant inflows where people feel they want to take advantage of vaccines. So all of these things are moving in the direction of where they see the post-pandemic economy moving forward.
Mm-hmm. Where do you see the biggest, ETF growth? I know we talked about thematics, but is there a country in Europe that will actually fare better than others in terms of investors wanting these products?
Investors wanting these products. I think we've seen significant increase in the private banks in Switzerland buying ETFs. I think another thing that we've seen, interestingly, coming to market in Europe over the past couple of weeks has been more crypto products. So the only place in the world where we actually have crypto ETPs is in Europe. And we've seen 2 new launches in the past 2 weeks. Van Neck now has a product, Wisdom Tree has a product, 21 Shares has a number of products. And what we are seeing is the assets are actually growing in these products. So they're now up to 2.4 billion. It doesn't sound like a lot, but given it's still early days and it always takes time for people to get aware of the products, how they work, we are seeing now that the products are listed on the Deutsche Börse. And so I do expect that that will be another thing where many investors see this as an alternative to gold. And this year we did see very significant inflows into gold, many seeing that as a safe haven, and also seeing it as a hedge to inflation, because many are concerned with all the stimulus coming into the market, do we have inflation coming and do they need some gold? And clearly, I think younger people and newer investors see crypto as a place to go as opposed to going to physical gold.
Great, Deborah, thanks so much. Deborah Further from ETF GI stays with us. Now, coming up, Vanguard took in less money in the U.S. in the first 10 months of the year than in any year since 2013. Here in Europe, it's scrapping its suite of smart beta ETFs. We'll discuss changing strategy at the world's second largest asset manager. That's coming up shortly, and this is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, we're just getting a bit of news out of the vaccine. Of course, as we get into 2021, we'll find out a lot more about COVID-19 and the reaction also to these vaccines. The UK is now warning, we understand, according to a press association, that those with significant allergy histories should not take the vaccine. But we understand also that if you call up and ask for a vaccine, there's a number of questions that you need to answer and, of course, fulfill the criteria before you get a vaccine. So try not to worry. If you want a vaccine, call a hospital, and they'll, of course, run you through it. Now, the world's second largest asset manager is shutting its suite of 4 actively managed ETFs here in Europe. Vanguard says it's pulling them because of insufficient demand from investors. This comes as the company took in less money in its U.S. home market in the first 10 months of the year than in any year since 2013. The squeeze is also affecting its biggest rival, while BlackRock saw total net flows in the first 3 quarters of the year dip 12% from a year earlier. For more on all of this, we're joined by Sam Potter, senior editor at Bloomberg News, who runs our ETF coverage. Sam, great to have you on the show. These European closures are by no means the only shift in strategy for Vanguard. Talk us through exactly what else is going on.
Yes, good morning. Yeah, the funds in Europe, they're kind of notable. As you mentioned, they're active quant funds. They didn't attract many assets. It's kind of small in the scheme of things, though, because what's more notable is that Vanguard is making some bigger strategic shifts at a global level, in particular in Asia, where it's withdrawn from Hong Kong, and from Japan. It's returned some $21 billion of government cash or government client money to China. And there have been leadership changes as well. So they have a new head of the international business, which they named in the last couple of weeks. And he's replaced like a 3-decade veteran. So it seems like Vanguard is being quite proactive, actually, and making some timely strategic adjustments. And these European funds are probably just a small piece of that puzzle.
All right, thank you so much, Sam Potter, there, our senior editor, and we'll get back to Sam throughout the day. Still with us, Deborah Furr from ETF GI. Deborah, Sam was bringing us a very important story. What's the read across for other ETF providers?
Yeah, so I think these active products were actually in the smart beta space, which is a space that we've actually seen significantly less inflows this year than in prior years. Half of the inflows we would have seen at this point last year. So I think investors have moved away from smart beta. They've had a struggle trying to figure out quite often when to invest into value, momentum, quality, size, et cetera. So they've moved on to other strategies that are more thematic or ESG. So in some ways, it's not surprising. So I don't think it's just about active. I also think that the smart beta trend has a bit dissipated in terms of ETF preference for investors.
Deborah, I know we were talking in the break about some of the things going on in the U.S. What will be, you think, the most significant development over the next 6 months?
Yeah, so we see the advent of semi and non-transparent ETFs. So that doesn't mean they're never going to tell you what's inside of it. What it means is they'll provide transparency on a quarterly basis like mutual funds, as opposed to what's required daily normally. And so what we're seeing is Dimensional Fund Advisors has now listed 3 ETFs. They're active, they're transparent, but what they said they're going to do in 2021 is convert 6 mutual funds with $20 billion in assets into ETFs. So far, no one in the US has converted mutual funds into ETFs. There are some challenges around tax, dealing with investors who may not have brokerage accounts, but they're trying to work through this. So I think this is very significant. They're going to lower fees. And for Dimensional, this is really important because historically, they have only sold their mutual funds through trained advisors. This opens up investments to all retail, financial advisors, and institutions. So this is a big change. And so I think that most asset managers in the US are trying to figure out what should my strategy be around ETFs. And they all feel they should have some kind of ETF offering. ETFs in the US are more tax efficient. That's not a benefit that we see here in Europe. But I do think that ETFs are just becoming a mainstay in in the US and Canada. And in Europe, I think investors are looking at ETFs more and more. And so I think the demand is growing in Europe as we've seen grow over the years in the US.
Thank you so much, Deborah Furler, Managing Partner and Founder at ETF GI. Now, that's it for this week's Bloomberg ETF IQ Europe. Of course, we'll be back with more, always, next Wednesday, 9:30 a.m. London time. We'll have a full roundup, of course, of the major news of ETF around the world, but especially in Europe. We'll talk trends, and also we'll delve into 2021, because, yes, it's already December. This is Bloomberg.
Position closed. So euro, as you can see, have £1,000 in profit. Closed it. I'll show you where. Just right here. Okay. I will adjust everything. That's it. Well done, guys, who followed, trade, who use our strategy. Made £1,000.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Table for two, Boris Johnson and Ursula von der Leyen meet over dinner tonight, but will the palate cleanser be enough so that they can reach a Brexit deal? A new stimulus deal could be underway. Treasury Secretary Steve Mnuchin presents a new $916 billion relief proposal. It's the first move by the Trump administration since Election Day to break a months-long standoff. And Investor Day at Deutsche Bank, we'll hear from the Chief Executive, Christian Saving. Later in this hour, I know he'll be quizzed about consolidation. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lackman, London, Tom Keene in New York. Tom, I may sing to you. Actually, I'm going to spare you just because it's your birthday. Everyone's excited about your birthday, apart from you. I know you're hoping that because it's 2020, it doesn't count, so you don't have an extra year. But Tom, happy birthday! Not only from me, from the whole Bloomberg Surveillance team. The man, the only man actually in Europe who can wear a bow tie with class and do it every day, Tom. Happy birthday. How are you celebrating?
We're celebrating by enjoying the pandemic. We are sequestered. I mean, Francine and I lead incredibly romantic lives, folks. We're thrilled that Mayor Bloomberg and the rest get us in a car to the office. Then we get back in the car and go home. And that's what we're going to do. We're just going to celebrate it like everybody else. I'm going to try to keep the birthday celebration under 40 people this year, just to stay within the guidelines.
Yeah, I'm trying to get you music. I'm looking down saying, like,
no,
do we have to Stevie Wonder happy birthday? We will, Tom, because
I'm going to say this.
In a difficult year, these things need to be celebrated.
I'll give you one birthday story, and this goes off of Bob Dylan's $300 million purchase of his publishing with Universal yesterday. I listened last night, Francine, to Nashville Skyline, which when it came out in, I believe, 1968 or 67, I can't quite remember, absolutely changed my life. It was an extraordinary benchmark in music recording, and it was great to listen to that last night. That was a few years ago.
Okay, we'll have that in the break, Tom, for you, because you know what? A birthday, I think last year I gave you a banana, like the art banana. Today we don't have that.
Can we continue?
Yeah, maybe we have a Brexit party. Now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine, Tom. The Trump administration is making its first move since Election Day to break a long standoff over coronavirus relief package. Treasury Secretary Stephen Mnuchin calls for $916 billion in spending. It would include aid to the states and liability protections for business. House Speaker Nancy Pelosi called it progress, but she said it shouldn't disrupt negotiations already underway. The U.S. government has an ambitious plan to vaccinate most Americans by next summer, but it rests heavily on 2 coronavirus shots that U.S. regulators won't get a chance to rule on until early next year. AstraZeneca and Johnson & Johnson together would provide up to 200 million doses of vaccine in the first quarter. The Supreme Court has dealt a sharp blow to President Trump's efforts to overturn the election results. It rejected a request by some of his allies to overturn Joe Biden's victory in Pennsylvania. The High Court's decision came in a one-sentence announcement and didn't say whether any justices dissented. British Prime Minister Boris Johnson heads to Brussels today on a rescue mission. He'll have dinner with European Commission President Ursula von der Leyen as both sides try to save Brexit trade negotiations. If there's no deal by the end of the year, the UK faces a number of damaging disruptions, including tariffs on exports to the EU. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thanks so much. Deutsche Bank out with some headlines here. We'll have much more on Deutsche Bank through the morning. It is their investor day, and they look for a better tone. No surprise there. What really gets my attention in terms of data in Deutsche Bank is their advantage by the alpha that we're seeing right now. October trading revenue up 10%. November trading revenue up a solid 23%. And you see it in this great bull market. Futures up 10, Dow futures up 109. The levels are unimaginable. Very importantly, the VIX did not come in yesterday. It should be a 19 VIX. It's not. It'll be fascinating to see what the VIX does today, 20.57. I'd also note in currencies, Mexican peso stronger into new strength, 19.72. An honor to have Augustin Carstens of BIS with us. I'm sure we'll touch on Mexico there. Francine?
Yeah, we certainly will, Tom. Now, a couple of things on the bank. So we are expecting that interview from the Deutsche Bank chief executive coming out shortly. It'd be interesting to know what he wants to do with the IB, if there's any mention of, some of the bonuses for the traders, and of course, the investment bank. The other banking news story is that the UBS Group chief executive officer, Ralph Hammers, who's literally just started, also faces an investigation related to money laundering at ING, where he was formerly chief executive of the Dutch bank. Overall, global stocks climbing. There's hope of a U.S. stimulus, and that seems to overshadow fears about resurgent coronavirus, Tom.
Very good. It'll be interesting to see. Why don't you bring in our esteemed guest here, the gentleman of a low interest rate environment?
Yeah, I'm delighted to be joined by Stephen Major, HSBC Global Head of Fixed Income Research. Stephen, I was going to let Tom, ask you the first question on treasuries because it is Tom's birthday, and I think it's appropriate for him to speak to his favorite guest first. But Stephen, when you look at what we've heard from a number of policymakers, I mean, what's the case right now of holding treasuries into 2021? Like, what's the return going to be like?
Well, we're probably at the top of the range, Francine, and I think that you have to show some strength in your conviction here, because it's difficult to imagine, in my opinion, a sustained break above 1%. And if we're in a range of 50 to 100 for the next 6 months, then I want to buy every time we're near 100. And that could be a winning strategy for the first half of next year. I don't think that treasuries can sustain a move above 1% because that would be openly challenging the Fed's current forward guidance and their average inflation targeting. They are telling us that they're on hold for 3 years or maybe even longer, that they're looking through the inflation bump that's going to come in the next few months. So the market is challenging that. I'm going to go with the lower for longer thesis that we've had in place for a long time now.
Steve Major, one of our listeners, John from London, emails in this morning about James Dimon and the comments that he has made with J.P. Morgan. Let's show the comments of Mr. Dimon yesterday. And what's so important here is Jamie Dimon, who's a really, really shrewd guy, said, I would not be a buyer of treasuries. I think treasuries at these rates, I wouldn't touch them with a 10-foot pole. And then you go back a few years in his statement, you better be prepared to deal with rates 5% or higher. It's a higher probability than most people think. Now, not to pick on my good friend James Dimon, but Steve Major, this has been the zeitgeist across your modern career, and you have nailed this. What do the inflationistas, what do the higher yield people get wrong?
Yeah, those who were calling for 5% yield when it was below 3 have lost a lot of money if they took that position on. I can imagine. What that view misses is the strength of the conviction of the Fed itself to keep the rates low. And in fact, I don't think the Fed has a lot of choice but to keep the rates lower. The inflation isn't really there to justify higher rates. And then they're saying, even if it was, they're not going to hike the rates. But the point is, the US and most other big developed countries cannot afford higher interest rates because they borrowed so much money. There is a very clear association between increasing debt levels and lower interest rates. And that's been going on for 20 odd years. Now, I don't think that's suddenly broken down in 2020 or 2021. So what the inflationistas are missing is that important link. And nobody has explained to me exactly how inflation goes up, apart from showing me some chart of money supply and inflation or some 1970s textbook. I mean, we need to hear the explanation as to how the inflation rises, and it has to be to do with wages. It's not going to be about oil or food or FX. It has to be about the thing that matters, and that's wages. How do wages go up when there's so many people out of work?
This is the heart of the matter, and I want to make clear here that James Dimon has, like HSBC, a wonderful research capability, and Joyce Chang and John Norman and the rest of them who have called for sustained lower rates, like Mr. Major. Steve Major, what you're saying is the output gap is there. Conventional economics works, and the wages can't move because there's an age of oversupply, as Mr. Alpert says, right?
Yeah, Yeah, until you close the output gap, until you've taken the slack away, it's difficult to see how inflation goes up. Now, as recently as 2012, the Fed had a forward guidance in place. Inflation went comfortably above 2%, but unemployment was stuck at 8%. They did not hike. We have the same situation now. So they're telling us that they're ready for inflation to go above 2 to try and drag the moving average towards that 2% number over time. But unemployment's not going to go down. And with Janet Yellen, by the way, in her new position, the expert on labor market economics, you would have thought that people would start to get this by now. It matters to get the unemployment rate down. It matters to get all the minority groups back to work. Only then, and with inflation above the average, can we start talking about higher rates? But we're a long, long way from there, Tom.
Stephen, what does QE actually do? Does it just stave off deflation, or does it spur inflation? And I know to your point, we did hear from Jeffrey Gundlach from Double Line, and he was expecting inflation, which is completely counter consensus.
Well, look, the inflationistas spoke about money supply and QE and inflation a decade ago, and that was completely wrong. The early architects of QE, including Mr. Bernanke, have subsequently changed their mind as to how it works. Most of the academic work and more practical considerations show that QE is a signaling device, as a channel of signaling. And I look at it as skin in the game. The central bank is not going to hike rates against its own position. So I don't think QE is any kind of magic potion. It's just a swap between reserves and bonds. There's no magic money out there or any silver bullet. And inflation just doesn't come through when you've got such a large output gap. So just because the balance sheet is bigger doesn't mean to say you've got an inflation risk.
Let's do this. Steve Major with us here. We're thrilled he's with us from Hong Kong today with HSBC. He has been absolutely brilliant over the recent years on interest rates lower for longer. Someone dealing with that is Christian Saving. He is with Deutsche Bank. We'll have extensive conversations with Mr. Saving beginning at 5:30 here and literally in 20 minutes. That will be must listen for all of global Wall Street. A better picture for Deutsche Bank as they pick up the pieces of a good set of difficult years. Futures up 9, Dow futures up 91. This is Bloomberg. Good morning. Good morning, everyone. Bloomberg Surveillance, Francine Lacroix in London and Tom Keene in New York. And very importantly, viewership for West Ham football has literally gone through the roof on the Pacific Rim, and particularly as Hong Kong, as HSBC leads with their best and brightest. Stephen Major relocating to Hong Kong for HSBC. Quite a statement from the bank on their research capability going forward. Stephen, we have the political issues of Hong Kong. I don't want you to comment on that. I understand that's inappropriate, but I do want you to comment on the dollar as a compensating factor given interest rate movement. You do follow foreign exchange because of that. Do you buy weak dollar given the calls for higher yield?
Yeah, I'll tell you a very interesting fact, that total return for a dollar-based investor, whether he be holding Chinese bonds, European bonds, UK bonds, US bonds, whatever, in dollar terms, it's been between 7 to 10% this year so far. So if you just bought a broad-based index of everything, you've had 7 to 10%. And in the case of buying China, recently, of course, you'll know that a good 5% of that's come from the currency, because the Chinese currencies had a good run. And that's after the dollar probably went too far. So for a fixed income investor, the fact that there's no yield, apparently there's no yield on offer, you can still make 7 to 10% total return, because you've got duration, you've got FX, you've got carry and roll, and sometimes the spread tightens. So, that's how I'm setting up for 2021. I'm thinking with a bit of skill and careful judgment of the ranges, we can look at trying to generate 5 to 10%. Mm-hmm. And I was thinking about this with the Treasury market. 50 to 100 is probably the range. Right. A dollar-based investor doesn't have to worry about the dollar. Obviously, an investor in Asia or Europe does have to. But I think that the unambiguous rise of the dollar that we saw in recent years, that's now being challenged, and it's becoming a lot more nuanced, a lot more complicated.
If I have lunch at the Ritz-Carlton in Hong Kong or the Mandarin, the Ritz-Carlton over closer to the water there, sort of pretentious and all that, or the fancy Mandarin redo, what I'll remember clearly, Steve Major, is counting every basis point in 2006. We had this disease of trying to do better. If I go to HSBC, I'll make 4 more basis points than if I go to JP Morgan. Are we back to that silliness now?
Well, credit is starting to get there, actually. So looking at credit spreads, they are quite comparable with that period before, of course, it all happened in 2008. So we look at the probabilities and think that it's not a good point right now to be chasing investment grade credit spreads tighter in Europe or the US. And in fact, you are unlikely to get paid well for that kind of trade at the moment. Maybe selective investment in high yield looks good. And we're thinking maybe we have a preference for Europe over the US at the moment, because you have a kind of a zombification. The paradox there, Tom, is that companies aren't failing because the governments and central banks are supporting them. So that's good for the creditor, it's good for the investor. It's not very good for the economy, because you've got unproductive companies surviving. So there's the paradox of zombification. But in credit in general, I think the point you made is right. IG, investment grade, it just looks too tight.
Okay, whilst Tom's having lunch at the Mandarin Oriental, Steve and I will go to the real place, the smallest Michelin star dim sum place, which is like a tiny hole in the wall, I think, in the Kowloon over in Hong Kong. Stephen, if you look at the ECB and what they're doing with a lot of these yield curves, have they effectively and de facto become a yield curve controller?
Yeah, they say they're not doing it, and I think the lady doth protest somewhat. So they say they're not doing it, and they keep saying they're not doing yield curve control, but they are, aren't they? So they have control over the short rate. They have good insight into the duration of the bonds they hold 1 month before we in the market know what they've got, because they report it a month later. They know what the weighted average maturity of all of the treasury operations is. So they have a huge amount of influence on the shape of the curve by their own purchases going up and down the curve every day with the PSPP and the PEP. So it isn't explicit yield curve control like the Australians or Japanese, where you have a target and a pure number, but they have an under the table kind of yield curve control, yes, and they can move up and down the curve.
Steve, thank you so much. Only Stephen Major of HSBC can actually quote Hamlet, and I think spoken by Queen Gertrude when talking about the European.
Yeah, Hamlet got the third shot yesterday. William Shakespeare got the second shot.
I think it was the second
Hamlet
one,
got the third shot after.
Yeah, I mean, it's amazing, actually, that an actual person from Coventry called William Shakespeare got the second shot in the vaccine. Thank you, Stephen Major, HSBC Global Head of Fixed Income Research. Now, coming up in the next hour, Gabriela Santos, JP Morgan Asset Management Global Market Strategist. We'll talk to her about emerging markets and treasuries. 6 a.m. in New York, 11 a.m. in London, and this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. Japan's SoftBank Group is debating a new strategy to go private. Bloomberg's learned that the plan calls for gradually buying back outstanding shares until founder Masayoshi Son has a big enough stake. Then he could squeeze out the remaining investors. SoftBank isn't commenting. Elon Musk is tired of being taken for granted, so he's moving from California to Texas. The billionaire co-founder of Tesla told the Wall Street Journal that California has become complacent with its status as an economic giant and is taking too much for granted. Tesla is headquartered in Northern California, but Musk is building a factory in Austin, Texas. And that is your latest Bloomberg Business Flash. Francine, Tom.
Thank you so much, Ritika. We're just getting some breaking news out of, the EU recovery proposal. We understand from the Polish deputy premier that Poland, Hungary, and Germany have agreed on an EU deal. Again, there was discussions earlier this morning, and I need to really try and figure out exactly how it ended and what the discussion was on and what the agreement was on. But they were discussing the possible end to this EU budget standoff, which could mean that the bloc, stays as one. So we could see a possible end of a standoff, but unclear at the moment to me, Tom, exactly what they've agreed on. So I'll dig a little deeper and bring it to you as soon as I find out.
A little lift to the euro on that, 10 pips. Pips is out 4 digits, ever so slightly. Euro stronger there off those headlines. We'll see if we can breach 121.45-ish, the high of, I believe, earlier this morning. The strength in the euro, I should say. Futures up 8, Dow futures up 88. Part of that theme is better global finance, which means better Deutsche Bank. We will have a conversation with Mr. Saving of Deutsche Bank. Look for that really momentarily. Thrilled to bring that to you here at Bloomberg with some sharp questions on the state of his investment banking, the state of his trading, and of course, the relationship of the institution to Germany. Please stay with us with, again, futures up 8, Dow futures up 86. We've got some dollar weakness this morning. I'm looking at the real yield. I have to, negative 0.97%. This is Bloomberg. Good morning.
The big concern is climate change. We can see the global warming accelerating at the moment, and the goals that we must hit are so ambitious. It's 1.5 degrees by 2050, being climate neutral in terms of emissions by 2050. That's a huge challenge. We have to reduce emissions by 50%, 2030, 2040 again. It's very, very ambitious, and mobility plays such a crucial role in there. One thing is to do it in developed countries. I think we're going to get there by 2030, but then the rest of the world, and that's just as important. If you look at developing countries, emerging countries, that's where probably the biggest challenge we are going to face, to also deploy EVs there and make mobility greener in those countries. I know it's possible to move mobility forward fast enough to be able to do its part in this fundamental threat that we're facing.
explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Deutsche Bank lifting its investment bank outlook, Tom, with trading income on pace for a record year. The firm says its trading unit surge into the fourth quarter will help to boost growth. Now, the chief executive, Christian Saving, I think forecast revenue for IB at 8.5 billion euros, while he also sat down with our German bureau chief, Daniel Schäfer.
I'm actually very proud what we delivered in the stable businesses. Everybody knows that because of COVID and the further headwind from the interest rates, that was an even more difficult year than we planned last year at the same time at the first Investor Day. And we have performed very well. We are in line with our plan on the revenue side, on the cost side. So we have really delivered, and that shows that the underlying growth in the stable business is strong, is resilient, and gives us the confidence for the coming years. In the investment bank, there is a clear outperformance, and we have underestimated the potential of the investment bank when we came up with the strategy last year in July. We performed very well in those businesses where we decided to be strong, where we decided to stay in the business. We have re-engaged with clients. The halo impact from exiting the equities business far less than we anticipated. And in this regard, and Mark and Ram will show that later today, the sustainability of the revenues in the investment bank is very strong. And hence, we are happy with the performance, but that does not change the strategy at all.
Okay. If we talk about, as you said, the outperformance of the securities unit, you've in late October, you've increased the revenue outlook to significantly higher. If we talk about the fixed income trading business, in the fourth quarter, has the good momentum continued, and could we even see double-digit growth in the fourth quarter once again?
Well, let's see. We still have a month to go, but I would say that the momentum in October and November was very satisfying to us. We have seen continuing good momentum in the investment bank. But again, you know, a year is over when 12 months are done, so we have to go through the December. But for the time being, I'm satisfied with the performance.
Okay, so overall it could be another very good quarter for the trading business.
You know, we are always trying to get better, and that means that of course it is our goal to be ahead of last year. And again, in October and November we have seen a good momentum, and now we have, including today, 22 days to go, and that's what we are doing.
Okay. And are we nearing the peak of the trading boom that we've seen? And what does it mean for revenues in the investment bank in 2021 and 2022?
Look, there is it is clear that some of the outperformance which we have seen has been COVID-related and has been market-induced. There is no doubt. But I'm really proud of the fact that in those businesses where we made changes last year in fixed income, but also in the financing business, where we focused on, where we said this is the strength of Deutsche Bank. When you look at the financing demands, it will be a global trend that there is more financing demand. Deutsche Bank is a powerhouse in financing. We clearly outperformed, and that's what I meant when Ram and Mark will present later today. They will show you in detail what kind of revenue stream is sustainable. And in this regard, I do believe that a good part of the outperformance which we have seen in 2020 is sustainable. And hence, we are confident also for the investment bank in the year 21 and 22, though acknowledging that some of the outperformance was clearly driven by the markets in 2020.
If we look at the corporate bank and the private bank, obviously there's an impact by the pandemic and also the continuously low interest rates. So how much more pessimistic are you about those two areas compared to 2 years ago when you started thinking about the strategy of Deutsche Bank?
Well, first of all, I think both have shown how resilient and strong they are in their markets. They have done everything to mitigate the additional headwind we, in particular, from the interest rate environment. The corporate bank has now charged and passed on negative interest rate to more than 70 billion of deposits. That is far more than we anticipated last year. And that makes us confident that the underlying growth, which we have seen in 2020, if we continue to do that in 21 and 22, we will achieve our revenue targets for both units. And further on, the headwinds from the interest rate will actually soften in 21 and 22 and in the following year.
Christian Saving of Deutsche Bank with our Daniel Schaefer. This is one of the great stories in corporate finance and global finance and commercial banking. Mr. Saving, starting as a 19-year-old trainee with Deutsche Bank long ago and far away. Matt Miller joins us now. Matthew Miller out of Berlin as well. Matt Miller, Mr. Saving, and I look at the success here. Is it all clear for Deutsche Bank?
Well, definitely not all clear for Deutsche Bank or Christian Saving. I mean, they've done really well, but it's largely due to a jump on the trading side of the business. And this is a CEO who wanted to rely less on the investment bank and more on lending. Of course, lending continues to be problematic. Deutsche Bank cursed by the negative rates of the European Central Bank long before Christian Saving took over the top job, but that curse continues to hurt them on the lending side. It's really trading that's helped, and they've pared down that business so much.
I mean, Matt, I look at 91,000 employees on the Bloomberg terminal. How many more to go? I mean, you're in the heart of it there, the emotion of domestic Germany and Deutsche Bank. Where will the headcount be 2 years, 5 years from now? Do we have any idea?
Yeah, absolutely. They've told us exactly how many jobs they want to cut until then, and they're ahead of schedule on that. So on the cost-cutting side, Christian Saving is doing really well. In fact, he's been helped in a sense by the pandemic because they need to spend less on office space. They need to spend less on travel. This is something I've spoken with him about in the past as well. So, you know, they're ahead of schedule on cost cutting. They're doing great, especially in terms of debt trading revenue. But it's the lending side that they've got to change, and they really need a change in the macro picture before they can do very much about that.
Matt, good morning from London. Are we going to see, you know, consolidation talk again of entities within Germany?
Yeah, the consolidation talk is never going to end here in Europe. I'm not sure so much about in Germany. I think the Deutsche Bank Commerzbank merger was nixed pretty permanently after they went through the initial planning stages there. But you'll definitely see more talk about consolidation across borders. The problem is none of the CEOs who run the biggest banks are willing to take the first steps because they don't think that Europe has taken enough steps to towards consolidation itself.
Matt, given what you've just said, is Deutsche Bank now too over-reliant on the trading arm?
Well, I'm not sure if they're over-reliant on the trading. It's been a real tailwind for them, a real help at a time when a lot of analysts and investors thought that savings targets were too ambitious, and this tailwind has helped him meet those targets. The question is, can he continue that kind of performance? I think one of the most interesting things we got out of Daniel Schaefer's interview, great interview, by the way, my bureau chief talking to the CEO of Deutsche Bank today, is that you're going to continue to get paid making these kind of gains for Deutsche Bank. So at a time when bankers are wondering if they'll be rewarded for their work, Christian Saving is saying they can expect to be rewarded by him.
Matt Miller, I got one more question. I could care less about Deutsche Bank right now. You, more than anyone I know, have nailed Bitcoin, the move up and then the skepticism and now another move up again. Is the move up this time in Bitcoin different than the move up the last time where you created the Miller fortune?
If I could remember my password, I really would have access to quite a bit of money. You know, the move up, I think, is it more stable this time, or at least this is what I hear in the Bitcoin community, is more stable this time because of the underpinnings. By the way, before I leave, Tom, I want to say I will never forget, and completely unrelated to everything else, when I first met you 15 years ago, you visited me at Finsbury Square. I think you just finished flying on one engine and took me over to All Bar One for the beverage of my choice and explained the game of ice hockey to me. I just want to say a heartfelt happy birthday to you. I hope you have a great day.
The magic of birthdays, Matt, and I think Francine can speak for this, is after the first child, there's that immediacy of needing to get to the next child to support the first child. So Francine and I expect news here at any moment, right, Francine?
Tom, I remember the first time I met you, actually, and it was also over, I think, a drink of our choice. And you were looking at LIBOR every 32 seconds. I'd say, he'd say, what you have to do is read about economics. And then you'd turn around and say, like, where's LIBOR? Where's LIBOR? So I always associate LIBOR with that very first conversation, Tom.
That's even worse. Mrs. Keene associates when we met with LIBOR as well. Let's lose this. LIBOR doesn't matter anymore. Either does my birthday. Matthew Miller, thank you so much for joining us today. In New York City with our First Word News, here's Ritika Gupta.
Thanks, Tom, and happy birthday again. Treasury Secretary Steven Mnuchin is trying to break the months-long deadlock over a new coronavirus relief bill. He called House Speaker Nancy Pelosi with a $916 billion proposal that includes aid to states and liability protections for businesses. Pelosi and Senate Democratic leader Chuck Schumer called the offer progress, but they're unhappy it doesn't include enhanced unemployment benefits. Some Democratic lawmakers are balking at Joe Biden's choice to run the Pentagon. If retired General Lloyd Austin is to become the first black defense secretary, Congress will have to approve a waiver that bars military officers from leading the Pentagon within 7 years of retiring. Lawmakers voted an exemption for Jim Mattis, President Trump's first defense secretary. And the UK will drop tariffs the European Union imposed on $4 billion of US goods. It's part of the long-running dispute over illegal aid to aircraft manufacturers Boeing and Airbus. The UK says it will set its own tariff policy when it completes its split from the EU at the end of the month. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine?
Ritika, thank you so much. Now, coming up, Tom and I are really looking forward to speaking to the BIS Chief Executive Officer. It's Augustin Carstens. We'll talk monetary policy, we'll talk liquidity, we'll talk bubbles. A great conversation coming up with Mr. Carstens next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Surveillance. Good morning, everyone. Francine Lacroix in London. I'm Tom Keene in New York. Thrilled you're with us today. Lots going on, particularly in Washington. We'll really dive into that in the next hour as well. Right now, a joy. Augustin Carstens is at the Bank for International Settlements in Switzerland. He is their general manager, as we talked to Benoit Correa the other day on Bitcoin and on the cyberspace. Right now, Augustin Carstens on where we are in our monetary theory. And we can do that because, of course, of his heritage with his Mexico and their monetary effort, and particularly going back to the University of Chicago long ago and far away, where he took his thesis with a giant Michael Musa. It was on the Mexican peso, the dynamics of the peso, and we're thrilled that Dr. Carstens could join us this morning. Augustin Carstens, the BIS is the research facility for all the other central banks. Tell us about the new weak dollar and how that will unfold into central banking. Is a newer, weaker dollar, an ascendant Mexican peso, and the rest of Pacific Rim currencies as well, is that a destabilizing force for 2021?
Well, I really don't think so. I mean, certainly it's a phenomenon to be watched. I think it's a natural result of a very aggressive monetary policy by the Fed. I think in a way it also reflects some search for yield going into emerging markets. In particular, you made some mention to the peso. You made some mention to some Eastern Asian emerging market currencies. And certainly I think that part of the search for yield is bringing assets, portfolio investments into the latitudes you just mentioned. And well, of course, a very, very immediate manifestation of that is the appreciation of the currencies of these countries. For these countries to see an appreciation of their currency tends to be positive because through the financial channel, the way of the debt becomes less, in particular corporate debt, and therefore the financing of investment can be better. Now that also comes with some risks because at some point there can be a change in sentiment, there can be different news coming from monetary policy front, but so far so good.
Dr. Carstens, the money question right now is within this pandemic and the application of all the debt that's going on, will we see smooth transfer to a better world? Will the reaction functions of central banking be controlled and stable, or do you worry about instabilities and jump conditions?
Well, I think we have to recognize that central banks have gone out of their way to have this made smooth. I think if we compare the way monetary policy is made today, a salient feature is that there is a lot of information, there is a lot of forward warning. I would say when I studied at the University of Chicago, you mentioned this at the outset, my professor used to say that for monetary policy to be effective, it needs to generate a surprise. And now it's a little bit the opposite. Now you want people to understand what you're going to do. You want to anchor expectations based on forward guidance and the actions that you undertake. I think also the central bank authorities, especially the Fed and other advanced economy central banks, have been very agile to, more than anything, prevent circumstances to disrupt markets, in a way, facilitating tradability. So I think that within limits, I think what the central banks are doing is to try to sail through a better scenario into the future as the main shock that is generating the dynamics in the global economy, which is the pandemic, gets resolved.
Mr. Carstens, how much of a risk is there that because of this liquidity by central banks, because of the search for yield, we're seeing bubbles? And are central banks and policymakers aware of these risks?
Well, there is no escaping that if you enhance liquidity dramatically, money will go in search for yield, and certainly it can expose assets to mispricing. At the same time, we can say that authorities are aware that this is a risk that it needs to be watched, and everybody is being very, very careful. Certainly today we can say that there are some assets that might be mispriced, some more than others. But at this stage, I guess that the reading is that we don't have systemic problems in our hands. But yes, this is a risk, and this is something that needs to be recognized and something that needs to be watched very, very carefully.
Mr. Carson, is there an economic case for central banks canceling any of the bonds that they bought during the pandemic?
No, I don't think there is any ground for that. I mean, I come from a region where sometimes that has been attempted, and it has been catastrophic. So I think that's bad economics. It might be good politics in the short term, but it's terrible economics.
What makes you worried about, terrible economics in general? I know there's a recovery fund. We could have a deal, but is there anything that you see as one of the main risks on the horizon which we're not paying enough attention to? Does it come from the political sphere, then damaging, credibility in the economy, or could it come from a policy mistake from a central bank or a policy maker?
Yeah, I mean, I guess what you're referring to is the proposal that has been around that the holdings of central banks of sovereign debt should be cancelled. But at the same time, if you do that as any financial institution, central banks have capital. And if you go on in this course, what you end up doing is eroding the capital of the central bank. At the end of the day, what gives credibility to the central bank is a fiscal backing, either implicit or explicit. But if you're going against that pillar, at the end of the day, you're eroding the trust on the system we have today. Therefore, I think it's tempting the devil if you go that route.
Dr. Carstens, thank you so much for joining Bloomberg today. Augustin Carstens with the Bank for International Settlements. We've got much more coming up. Again, futures up 7, Dow futures up 89. An important interview on the state of private equity. David Sandberg with Apollo. Look for that in our next hour. This is Bloomberg. Good morning.
It goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonizes it, turns it into a carbon-rich material. Obviously kills all of the pathogens.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I'm not a strong believer in Bitcoin. For all the reasons it's a strong developing asset class, it may fail.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. I'm Francine Lachman, London, Tonkin in New York. It's a Tonkin birthday data check. A lot of the focus is, of course, on some of the positive news coming out of the stimulus. A lot of the focus is on what will happen with Brexit as Boris Johnson travels to Brussels to have dinner tete-a-tete with the European Commission presidents. Now, the stocks overall are rising. We're very near record highs in certain countries, actually touching record highs. And I have to say, it's hopes for this stimulus deal that is overshadowing fears about resurgent coronavirus. Treasuries slipping with the dollar, and you can see a pound. I should also look at euro sterling, but for the moment, cable 134.54. Tom.
No, sterling comes back. Dinner tonight on the 13th floor there in Brussels. Wonderful building. Just love the building right down from where we usually broadcast in Brussels. My data check right now is simple. Let's do foreign exchanges. We've under-talked it today with all the distractions going on. Pacific Rim stronger. ADXY, that blended index, is buttressed right up against new strength, much like the equity market. As we talked to Dr. Karstens, Mexican peso was my keynote this morning, 19.71 on peso. To remind you, 4 years ago, peso literally traded off the Trump-Clinton debates in the vicinity of 20.4, 20.6, something like that. And we're in almost a full stick of Mexican peso strength here, showing some of the dynamics of weak dollar. That'll be a key theme for us with Gabriela Santos. She's with JP Morgan Asset Management. Are you in international investment? No. She'll explain the courage. Stay with us. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
morning. This bull market continues up 15%. These 343 days of 2020, up 12% per year for the past decade, up near 11% per year since I was born. Let's get it straight. It is not a single-digit stock market. America, well, they'll need more than one vaccine. Perhaps Johnson & Johnson, J&J to the rescue before summer. And order, all rise. So I have a few questions for you, Mr. Trump. What is this, Judge Judy? No, the Supreme Court says to Mr. Trump and his allies, no, we will not hear the case. Good morning, everyone. Bloomberg Surveillance. Tom Keene in New York, Francine Lacroix in London. Francine, dinner on the 13th floor. I can't pronounce it. Berlaymont, whatever that beautiful building is. Berlaymont in Brussels. It's really cool. Like she lives, van der Leyen lives there in a private apartment, tiny private abode just off of where they're going to have dinner. I mean, it's very simple, isn't it, for the leadership of the EU, the EC?
I don't know how simple it is if you're, over dinner, a tete-a-tete between, Boris Johnson and the president of the Commission trying to thrash out a Brexit deal because you're, the people that were negotiating didn't manage a deal. So it'll be interesting to see the menu, Tom. I know, we laugh about it. Is it fish? Is it going to be French fish? Because there's so much contention about fisheries. But actually, it really usually sets the tone of whether they'll find a deal or not. But the story of the day, the other story of the day, and I love doing this, Tom, because I know you don't like your birthday, is it's your birthday. Right. So I was going to sing some Stevie Wonder. I decided the best of it. I decided to save everyone actually from my singing, Tom. But it's your birthday, and we kind of remember, one of the most fun moments that we've had was talking about, standard deviation points on Turkish lira and things that
it's very exciting.
To some may seem obscure, but actually to Tom Keene, not so, Tom.
I have the clearest memories of my 10th birthday long ago and far away in the time of John Fitzgerald Kennedy talking Turkish lira at the birthday party. Actually, we just seen Peter Ustinov or whatever in Top Copy. That was what got us going on Turkish lira. Right now, let's avoid birthday greetings and get to the first word news. Here's Ritika Gupta.
Thank you, Tom, and happiest of birthdays. The Trump administration is making its first move since Election Day to break a long standoff over a coronavirus relief package. Treasury Secretary Steven Mnuchin plan calls for $916 billion in spending. It would include aid to the states and liability protections for business. House Speaker Nancy Pelosi called it progress, but she said it shouldn't disrupt negotiations already underway. The U.S. government has an ambitious plan to vaccinate most Americans by next summer, but it rests heavily on 2 coronavirus shots that U.S. regulators won't get a chance to rule on until early next year. AstraZeneca and Johnson & Johnson together would provide up to 200 million doses of vaccine in the first quarter. The Supreme Court has dealt a sharp blow to President Trump's efforts to overturn the election results. It rejected a request by some of his allies to overturn Joe Biden's victory in Pennsylvania. The High Court's decision came in a one-sentence announcement and didn't say whether any justices dissented. There's a deal to unblock the European Union's $2.2 trillion budget and stimulus plan. Poland and Hungary have agreed on a compromise with Germany. That's according to the Polish Deputy Prime Minister. Poland and Hungary have vetoed the funding plan. They objected to tying funding to adherence to the rule of law. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg, Tom.
Up and away, some gap jumps here coming off the September lift in the market, and we saw another one yesterday with a real solid move out to record highs. It continues today. Futures up 8, Dow futures up 85. Let me give you those levels because we're losing touch. 3710, 3710 SPX. Dow. I'm not on a 31,000 watch yet. 30,253 on the Dow. Yields come in, yields flat, I should say, and the 10-year yield 0.94%. I stand corrected. 10-year yield actually lifting here. Farrell would have done better there than I am. We almost got to 50 on Brent crude, 48.83. Francine, I'm blowing up this data check. Help me.
Okay, global stocks, Tom, are climbing towards another record high. A lot of the focus is, of course, on the stimulus deal, and it seems to be overshadowing fears about the resurgent coronavirus. And then, surprise, surprise, we're still talking about Brexit. The pound rallying as the UK Prime Minister travels to Brussels a little bit later for dinner with his counterpart from the Commission, Ursula von der Leyen, to save these Brexit negotiations. So I don't know if anything will come out of it, but certainly the market is on tenterhook.
Well, there'll be the heat wave you hear tonight will be me blowing out the candles on the cake here in New York. Last year, the Upper West Side was singed. And when I do that, I'm going to make a birthday wish that the Eagles keep it within 20 points against the New Orleans Saints. Joining us right now, Kevin Cirilli, Eagles fan, and, of course, someone in tune with Washington events. Kevin, there it was, the Supreme Court saying to Judge Judy, no, you can't do that. Is that, I didn't get this in the articles, including from Greg Storr. What is next with Mr. Trump and his allies in the Supreme Court? Was it done last night, or can there be more?
Not much. I mean, look, there are more than 38 cases across the country that have been thrown out by judges, Tom, in terms of the filings of the president as well as his allies who have filed cases. Now, there are two main things here. First and foremost is that in the document that came out from the Supreme Court, they did not have any type of narrative statement, no dissents, no really ability to see what the general thinking was in their not taking this up and dismissing this. But secondly, take a broader step back here, 10, 20, 30 years down the line, when people are looking and studying the 2020 election, they will only look at this case as a footnote in history because there doesn't appear to be the type of major episode from the Supreme Court as an institution akin to what we saw in 2000. In other words, this is the highest court in the country that has not been politicized as an institution, despite the warnings of such coming from the occupant of the White House currently.
Kevin Cirilli, let me switch gears just because of the news flow. How much of a slap in the face is a single $600 check versus the check a month plan?
You know, look, I think that when you look at the current state of the negotiations, there's no question that the $600 check is going to be something that Senator Bernie Sanders and Congresswoman Alexandria Ocasio-Cortez are not going to be able to get behind. They've already said as much publicly. But from another perspective, Senate Majority Leader Mitch McConnell, in negotiating, has shown a willingness to remove liability protections. The Democrats have also shown a willingness to significantly lower their two at the original state, $3+ trillion, then $2.4 trillion price tag. And so the bottom line here is that this is an initial round of stimulus. It's impossible to look at this that there is any clear winner on either side, or if you triangulate it, even coming from the White House. And as a result of